Yeah, no. So, Sarah, we've just seen an environment this year where, the market can't hold on to any rallies. What we've seen is, especially in the last hour of trading, we still have a few more days left in the month, but if it were to end today, the month, it would be the weakest last hour of trading for the S&P, going all the way back to October 87. So, and that was a bad month, as most people either remember or have been told. So there's been some really, steep selling pressure. This week we saw 2 days in a row where the NASDAQ was up 1% intraday and finished down that same day down more than 1%. That hasn't happened since 2001. And there's only a handful of days going back to the mid-'80s where you've ever seen that happen on back-to-back days. So there's just a complete lack of buyers out there. Maybe the retail money that had come into the market is not as eager to buy here. Mike was outlining the risks in the market that people, that have been well broadcast. So, that the Fed is tightening, that the economy is slowing down a bit, and those are all headwinds for the market. And I think people are just, trying to take profits where they can.
I think what's particularly ugly is the action in some of these tech stocks, the FANG names, like a Netflix, which is down 23%, and Amazon down 5%, Paul. These are some of the most widely owned stocks in the market. How much do you think that is contributing, the fact that it is causing a lot of retail and institutional pain and potential margin selling with some of these names?
Yeah, so you typically don't see $250 billion companies lose 25% of their value in a single day. So that is definitely volatility that people aren't used to seeing. And we're seeing that. We saw J.P. Morgan Chase last Friday had its worst earnings reactions day in over 20 years. Goldman had one of its worst in 20 years earlier this week. So there's real sell the news reaction in stocks reporting earnings. Of companies that have reported so far this month, on average, they're declining close to 2% from the open to close, even if they gap up higher. So, what we're seeing is investors just, again, they're taking the opportunity to raise cash. And when you look around, you haven't seen really anything going up in price. Even the dollar you just mentioned was down. So it's been a lot of there hasn't been many places to hide, but eventually, we're hitting some extreme oversold levels. Sentiment on the part of investors, based on the sentiment polls, is in the lower decile of its historical range, and that's even before today and yesterday's trading. So those kind of things, should at least set the stage for some sort of short-term bounce here. But it is a midterm election year, and midterm election years are known to be extraordinarily more volatile than the average year.
So, Paul, what would give you confidence that we are about to have that short-term or even longer-term bounce? What factors are you still looking out for that we haven't had yet?
Well, so a short-term bounce, you're just looking for, the extreme oversold readings. And depending on where things shake out today, we could be close to those levels. But, next week we have a Fed meeting. What's going to happen, we'll see what the Fed says, coming out of that meeting. Unfortunately, we're in sort of a blackout phase right now, so we're not going to hear anything. But again, I think if I think there's a concern on the part of investors that the Fed is going to hike too much as we're hitting some slowdowns in the economy. Housing data this week wasn't exceptionally strong. Retail sales has shown some weakness in the last few months here. And we have fiscal headwinds facing the economy here. So a very aggressive Fed could be a 1-2 punch that would, really hurt sentiment and could pose a roadblock for the economy.
Paul, thanks so much. We appreciate it.
All right. Thank you. Have a good weekend.